Welcome back to Inspired or Acquired. This is a podcast where we interview real business owners, talk real numbers, and ask them whether or not they would sell their business. We've got Matt Glaros on the podcast. He is in Southern Indiana and an old college buddy, and he's involved in the health insurance business, and he's also actively buying and growing printing businesses. So we're going to hear about the dynamics between both of those. And as always, I'm joined by my co-host, Clint Fiore, mergers and acquisition specialist out of Texas. So, fellas, it's good to see you. Matt, how are you today?
Another day in paradise, man. But to be clear, it's Northern Indiana, not
Northern.
Southern.
Excuse me,
Yeah,
Northern Indiana,
like right outside between Chicago and South Bend. So,
got it.
I don't want to get confused with anybody from Evansville.
For folks who don't know, tell us a little bit about the different businesses that you're involved in and what you guys do.
Yeah, so I think it's probably best to start with like what I'll refer to as a legacy business, which was the insurance business, because the print businesses have kind of morphed and become part of our long-term strategy in the last like 2 years. But originally, I'm just an insurance kid, right? Like my dad, all-time insurance brokerage. I grew up with him going out and selling life insurance policies as a kid, and then going and selling them to different businesses. We were in a major market. So like we were outside of Chicago, and it was just kind of a standard business, from an insurance perspective. I joined him after Pat and I went to college together at the great University of Denver. I'm a couple of years older than him. I can't tell by looks, but yeah. So I graduated in 2006. I went to the hedge fund world for a little while, realized I wasn't smart enough or crazy enough to stay in that one. I went back to work for my dad, who at the time had a whopping 2 employees. And I wanted to get into something where I kind of knew long-term path-wise I'd be okay financially. And I wasn't sure what was going to kind of come of it. And, we decided in like 2010 or so, he was at this like juncture of his life where he's like, I want to sell the brokerage. And so he thought for a minute we were going to sell to like one of these big brokerages out of Chicago or Indianapolis or one of the nationals. And that was right when Obamacare hit. And he's like, you know what? Well, let's not do it. Let's just go and see what happens. And he goes, but I got one thing. I don't want to grow this business like from a people perspective. I just want to sell insurance. So if you want to grow it, you kind of develop a plan and figure out what you want to do. And so that was like 2011. So Obamacare had just passed. And we had thought like, man, individual health insurance is going to be all the rage. Like everyone's going to want individual health care and group health insurance, which was our like bread and butter, is like really the only thing we did, with the exception of like life insurance policy here and there. Like it's going to the side. So we got to figure out how we can do individual health. And so at the time I decided I conned my dad, would be a good way to talk. Like I said, hey, we need to join up with a property and casualty agency to try to figure out how we can capture all their individual like policy owners so we can get the individual health, and then we're protected when group health goes away.
Yep.
And so we did that. And funny enough, group health never went away. It actually grew faster between like 2012 and 2018 than it ever did before. But we had built this great relationship with the Myers family. And my dad had worked with Larry Myers. And so we went from a whopping 3 people to like 12 people by 2016 or so.
Nice.
In 2018, Jeff and I, and Jeff, you'll hear his name come up a lot because he and I are, we make together, but apart from each other, we can't make a full sentence. So he and I came together and kind of came up with this idea that we would buy our dads out. And so we made this goal to buy them out by 1/1 of 2018. And that was to take over the benefits and the property and casualty, because prior they were kind of separate. And the one rule Larry, who's Jeff's dad, and Will, who's my dad, they had was like, hey, we don't care what happens. We'll share in a lot of stuff. We're just not sharing in money. And we said, all right, that's cool. But we said, if we want to do anything, we've got to join these two together and like build an actual insurance brokerage that prospers together. And so in 2018, Jeff and I made the deal with both Larry and my dad that we'd buy the majority of the businesses out at that one time. At the time, here's your laugh, I'll tell you. We were probably right around $2 million of revenue, about 10, 12 people. We bought it in 2018. We bought a building in 2018 as well. Brought on like a guy who had been working at one of the big houses, decided he wanted to buy in. So we got a little bit of capital. We could buy the building, like redo it. And we started growing the insurance business pretty quick. So between 2018 or like June of 21, we took it from call it 2 million to like 4.2. Yeah. And so we had some pretty fast growth, primarily in the benefit space, because that was really the pain point, right? It still is for a lot of people, the pain point from an insurance perspective. During that time period, we moved what was 12 people that turned into 18, then to 24 into an office building not too far that Jeff and I decided we were going to take a gamble on. And he normally comes to me, like he's in operations, like he sees stuff. And he's like, I think we should buy this like really dumpy building. And I'm going to tell you a funny story associated with it. So he's like, he takes me and we're growing the insurance, we're doing all the other stuff. He's like, we got to go look at this building. I'm like, all right. Takes me over and it's on 2 acres on this main through street, right? And I'm like, well, it's cool, but like the building's a dump. And they wanted like, call it $750,000 for the building. And the building was big, 20,000 square feet, or it was 16,000 square feet. And he's like, but we're going to have to dump like, I don't know, call it $1.2 million into the damn thing. And I'm like, all right, I don't know if we have $1.2 million, but like, we'll find a way to do it. Maybe we can finance it and figure it out. And he saw this whole thing the whole way through. He's like, I think if we turn it around, we'll take up like 3/4 of it and we can rent out the back. And so we're like, all right, like I just trust it the whole way through. And I think there's like something about that partner relationship that he and I have where like he comes to me and maybe every once in a while I'll be like, dude, this is the dumbest thing I've ever heard. But sometimes you see it, but you don't know how we're going to get there.
Yeah.
And this was one of those ones, like a few other deals where we've looked at it and we're like, I think we can do this. And so we bought this building and did a whole deal and moved everybody into it. And then COVID hit, right? And so we had this huge building. Nobody wanted to rent it. None of our employees wanted to come into it.
Everyone's out.
And we went virtual, right? And so in 2020, we continued that path of growth, which was great. And we were sitting in a bar, as we normally do when we come up with really good ideas. And we sat there and we're like, you know what we need to do? We need to bring private equity money on. Like, we need to go raise money. And at this point, we thought we were way cooler than we were. And we decided to go out and try to raise money at a $4 million insurance brokerage, which is theoretically impossible to do because nobody wants to build a private equity base off a small little brokerage like that. But we happened to stumble upon some guys that wanted to invest in it that were starting their own private equity fund at the same time. And so what we were able to do in June of 21, was we took on investment money to help grow the insurance business and build our relationships in like the Northern Corridor of Indiana. And so we brought in some partners in 21. And from there, the business went from 4 million to 6.5 million about 2.5 years later, right? So we just continued this path of growth. And then in 2024, just kind of paraphrasing the whole story of all of it, we'd gotten to a point where like growth-wise, we had hit some really good like trigger points, and we got this awkward teenage phase, right? Where like we weren't big enough to be a large regional player, but we were too big to be a small local player.
Yeah.
And we were either going to have to decide to like really buckle down and like say this is going to be a 10-year run, or we got to find somebody to partner up with to figure out what the next 10 years looks like for our clients and for ourselves. And so this is kind of getting to the spoiler. We decided to sell in June of 2024 to Hub International. We went through a variety of processes and like looking out who we were going to work with and who we wanted to do deals with. And then in 24, we decided, you know what, they seem to be the right partner, what we wanted to do fit wise. And that business was acquired. It was not just inspired. So
Nice.
I'll stop there to answer any questions because I paraphrased 15 years in a matter of 5 minutes. So,
okay. So this was your first kind of acquisition where you got acquired, I guess, was in 24.
Well, I would say our first real liquidity event actually happened in 21.
That was the PE money.
That was the PE money coming in. They helped, clear up. Like my dad still had a good amount of investment in it. Jeff's dad had investment in it, and they were able to come in and give him a really good liquidation event at that point in time. Okay. Looking back at it now, knowing what I know, like we definitely traded at a much lower multiple than we should have, but it was the right thing at the right time for us. It was the right relationship for us at that point.
Hey guys, wanted to take a quick break from the show just to tell you about our companies for a second. I'm Patrick Dichter and I own Appletree Business Services. We do quality accounting and tax nationwide. So if you're running a business or looking to buy a business, we'd love to help you out with accounting and tax services. You can find us at appletreebusiness.com. And Clint, tell us about Bison Business.
Yeah, Bison Business is my firm. We do nationwide M&A. So we help people buy and sell companies. Most of our customers have companies in the 1 to 20 million revenue range, profitable businesses. So if you've got one and you're ready to get acquired, you can reach out to us at bisonbusiness.com for a complimentary valuation. We can get you to market and get you sold. If you're a listener that's a buyer that wants to buy a company that size, make sure you're on our email list because we'll send you out deals first before they hit the market anywhere else. But we'd love to serve you anytime you're thinking of acquiring or selling your business. We want to be your first stop at Bison Business.
Awesome. Now back to the show.
Take me to the 24 moment when you sold majority and did the bigger deal. Was that driven in part by the PE money that you took on? Were they in this conversation, or was it just the teenage years things you see like, we're going to have to do something totally different if we're going to go?
Yeah, it's a really good question. And I'll give the guys, we worked with the group, the PE firm is called Graham Allen Partners out of South Bend. Small PE group, primarily it was originally just one guy's money, and then he decided to go out and raise other ones. And they had this thesis that was essentially the thought of like, hey, let business owners be business owners, and we're going to just come along and like support them in the ways that we can. And they did exactly that. And it was actually funny. I remember where I was when we were talking to the guy that was our main relationship manager at the PE firm. And I just said, hey, look, I think we can get a really crazy multiple because we're unique in the space because Jeff and I are both at the time, right? Like I'm a couple of years older than he is, but like we hadn't even hit 40 years old yet. And the insurance industry is stale, pale, and male, right? Like there's just not a lot of young people in it, and let alone like young, aggressive people that understand how to run a brokerage or how to do it. And so it was actually us saying like, hey, let's go kick the tires. And I knew a lot of guys at like the big five, right? And they would always come and be like, look, you guys are worth way more than everybody else because you have a few characteristics that are uncommon in the industry. You're young, you're growing. We developed some technology halfway through it that like is essentially TikTok for benefits. So we started doing like TikTok and educating health plan, and that took off and helped us grow. And so like we were doing stuff that like your traditional brokerage wasn't doing. And so they literally said to us, they were like, whatever you guys want to do. Like we've made our money at this point in time and we're good. Like, could we maybe make more if we held on to it? Yeah. But like if the insurance markets soften and the multiples come down, we're going to be at the same number if we get, if we go from 6.5 million to 10 million, but the multiples come down a ton, we're going to be at the same number we are today. So, I think for us, it made a lot of sense. For them also, and I look at it from everybody's perspective, because I know enough about PE to know that I don't know enough, but everybody loves a win, right? Everybody loves to be able to show on the chalkboard, like we won this thing and it was a good investment for the LPs, for everybody. Like it made sense to do the deal. And so they let us kind of lead the decision, and they never forced us into anything, which is probably maybe a little rare. Maybe it was their infancy of like being a startup PE, but it wound up working out, I think, for all of us, fantastic.
Can you share what the crazy multiple is or range or like? I'm sure
yeah, some of that stuff's under NDA, right? But I can say that the range can be anywhere. We were somewhere between 15 and 20. right? And so, and I would say there's some factors that drives our multiple up higher than others, but it's not uncommon to see those in the insurance space as a whole. Everybody hated insurance 25 years ago from an acquisition standpoint, and then people realized in '08 there's one business that didn't take a dip, and that was insurance. Like, there's not a business in America that can operate without it. It's banking and insurance. You got to have both. That's just, and I guess accounting too. You gotta be able to find.
Or the multiples are insane. So are your guys' dads like, congrats, like in awe of just the growth and exit, or what's the feedback?
Yeah, I think those guys, I think there's probably like a little bit of good and bad associated with it, right? Because when you go roll up, and I always say, like, remember back before 2020 or before 2014, there were two separate agencies. So these aren't like 100-year-old company names. They were 10-year-old company names, but two families that have been in the insurance world for a long time. I think they're both, over the years, they've done very well in all the different situations, right? And then in 24, it was really Jeff and my time to kind of get an opportunity to take a bite out of that. But I think for all of them, like, Jeff's dad's still working. My dad is still working in some capacity, right? He'll never stop. He'll continue working until the day he dies. If he's getting a paycheck or not getting a paycheck, he will be here because he just loves the insurance world as a whole. But yeah, I think overall, I don't think either one of them would change. I hope, and maybe they would, but I would hope that they would say the path worked out for all of us in that too.
This deal is so fascinating. I mean, you got this great multiple.
Yeah.
You rolled some of that into the bigger company, or like, how did you take home a bunch of cash, or like, how was that kind of
Yeah, so the way that insurance deals typically work, and this is the same for our original deal back in 21 as it was in 24. So our original deal in 21, when we did the first private equity deal, was we sold half the business to the private equity firm. We took half in cash and half in stock, right? And then when we rolled around to this most recent deal in 24, there's a portion, I can't disclose the amount, but there's a portion that we could roll in equity and take in their stock, which has performed really, really well over the years. And then there's the majority we took in cash. And we also have levers too, like trigger points. So like in all the deals, the original deal had a 3-year earnout. So we'd have one earnout in year 1, one earnout in year 2, and one earnout in year 3. This deal that happened in June, we have time with a true up at the end of our first year, and then we have a 4-year earnout afterwards, with the majority of it all coming in the 4th year if we hit certain hurdles, right? But the majority of the take, I would say, call it 65-70% of the proceeds is paid up in year 1, and then these additional trigger points are paid out through the next 4 years as they go. But they're growth driven, right? So like if we stay stagnant and don't do anything, then we don't get any more money, right? And so I have clients say to me all the time, they're like, "Sir, are you retiring?" I'm like, "No, I'm 40 years old. I can't retire." Like, first of all, I got 4 kids that I got put through college. And number 2, there's way more at the table for me long-term wise, both just professionally and then also from an earnout perspective, that you can't. Like, they're smart enough to realize they can pay those high multiples because of the fact that they know you have to grow, right? And being 40 and I got a lot of energy, it's like, let's grow and go as fast as we can. And there's really nothing we aren't chasing right now from an insurance perspective.
This is such a fun story to follow. So you're now working with this bigger company, and you had said before the show, this kind of opened the lid for you, right? Like you're able to chase down all kinds of lines of business and geographies that you weren't going after. How long ago did you close this deal? And can you give us an idea of growth?
So
that's happened.
Deal closed 6 months ago, 7 months ago, whatever the time period be, is June. And here's what I didn't realize going into it. And this is where like insurance, where market access matters, but also name matters for like some of these bigger companies. The moment we sold I had buddies who were in private equity that would never give me the time of day, right? I got buddies that are auditors, never give me the time of day. I'd have banker buddies that would just be like, the small regional bank guys would call me, but none of the big guys would call me. The moment we did our deal and it went public, my phone started blowing up. And I'm like, what in the heck's this about? And I was meeting with an auditor guy who works for one of the big five. And I'm like, why did you call me? And he's like, look, I can't refer a small regional insurance broker to my national client that does 500 to 5 billion in sales. They would laugh me out of the room. But if I tell them you're with one of the top five, guess what? I'm not getting fired, and the person that hires you is not getting fired, or something goes sideways. And I was like, is it that easy? And he's like, yeah. He's like, you just literally have to have the name recognition behind you. And so I'm like, all right, maybe this is true, maybe it's not. And because we had done some private equity deals back a few years ago, a lot of the guys I've worked with had moved on to other private equity firms. And they'd all called me. As soon as the deal was done, they were calling me like, hey, congrats. But then all of a sudden they're like, by the way, we have a deal. Do you want to look at it? Yeah, sure. They're like, well, it's this kind of insurance. And I'm like, guys, I sell benefits. I don't sell reps and warranties. Like, they go, yeah, but Hub does. Mm-hmm. Can you connect us with the guys? And I was like, yeah, we'll get you connected to them. And so it just opened up a whole set of insurance that we never had the capability or the expertise to sell. But now I have specialists that do insurance I never even heard of before. They have specialists that do it. So now there's not anything in America that theoretically I can't go and do a deal on from an insurance perspective. And to give you an idea, like my best year, and you have a book of business, right? So the insurance business is like, and some people understand it, but some don't. In the employer-based insurance, so it doesn't matter if it's property, casualty, or benefits, if you sell them a policy, you're going to continuously get paid the same amount for the most part, year after year. So it's just, it doesn't drop down, it stays about the same. Maybe it grows a little bit, but for the most part, it's consistent. So it's a very consistent growth. So you have a book of business. You're essentially rated on what your new business production is. So in a good year, we'd say, oh, a good year is 150,000 or 200,000. A great year is 300,000. A really good year is maybe 500. And my best year prior to 1/1 of 25 was probably 550,000 or 600. It was like 550. For January 1, I did $600,000 new business for January 1 alone. And for the rest of the year, I was looking at my pipeline for the rest of the year, actually earlier before this, and there's like another $1.5 million to $2 million worth of like active work I'm working on that I'm going, I'm going to sell. I sold more in 1 month than I did in my best year ever. And so like to answer like the long-term roadmap on this and like runway is so much bigger now for us than it was before because there's right. And so, yeah, I drank the Kool-Aid and the Kool-Aid like kind of helped. And it's turned into be a long-term path on this.
So I think this is neat. I'm going to actually, when this airs, I'm going to send the show to a friend of mine that I'm working on a deal for right now. Okay. They're thinking about selling to a national company. I can't really get into the industry details without giving too much away, but the pitch of this acquirer is basically, look, you're a specialist in this one vertical. We have 40,000 customers across the country because my client is the seller and he's got one specialized thing he does in one localized region.
Yep.
And then he says, look, we're basically 40 times bigger than you. And we can take your specialty to all these other geographies, but also we can take your specialty to all our existing customers across all these other geographies, and we can train our team to help fulfill it. So if you can sell it, like we can service it. You don't have to do all the work yourself on all these accounts. And so it is a way, they're thinking you shouldn't just be able to incrementally grow here. You should be able to exponentially grow here. And you just proved that out with like, you did a 1 month of sales better than your best previous year. Now that you're with this big event.
I would say we had essentially like 10 and 12 salespeople underneath us when we sold. So we were around 45 people. when we exited. And I would say the ones that were actively trying to sell are all selling more, right? And for your client that you're working with, it's one of those ones where like, and we say it all the time. And I was talking to the leadership guys here or at corporate, and I was like, look, the really good salespeople are the ones that are technical insurance people first, that then have the resources of all this other stuff on top of it, right? Like all you did was make me more dangerous because there's nothing I can't sell. I understand enough about everything else. I can bring the expert in to kind of help get the other pieces put together to the puzzle. But you have the expertise and you already know it. You're way more dangerous than like somebody who can just sell a story. It's like we have the technical expertise as well.
I dig it. So there's so many offshoots. We have to keep this conversation, a lot of it around, transactions and valuations, and how do owners of businesses think about selling the business versus not selling the business. So I feel like you took us into your head a little bit in 24. You thought it was kind of a combination of you're at this awkward phase and multiples were super high, and this is gonna give you a liquidity event and a way to keep making great money and grow. And so it seemed like all the stars aligned here. You decided to do this acquisition. You're moving forward. But now that you just did that 6 months ago, and it seems like your hands are very full, and I haven't even mentioned the 4 kids yet, right? and everything that's on your plate. How in the world are you acquiring print shops right now? Let's open up that can of worms. Like, tell us about the print business and how are you getting into the print?
Yeah. So I'll say one thing, and this is I'm going to steal a consulting word or a private equity word or whatever it is. This is my thesis when it comes to businesses, right? And it probably goes back to my upbringing as a kid. My dad watched his dad go from boom to bust, right? So like one day my dad's driving whatever car he wants in the driveway of 5 different cars. The next day, his dad's getting all the cars repoed and everything's gone because the business went under because of bad accounting in their situation. But like that story crafted who my dad became, which was a very conservative, like, I'm not going to take a lot of risks. I'm going to build a really good, strong financial business. And I'm not going to I don't want to trust anybody else to do anything because that's how my dad got screwed, right? I'm probably a mixture of my dad and my grandpa and good and bad of both of them. But as I looked at it from like an opinion of like selling, and then I'll go into the print shop side of it, was in business, everything changes. So like you can be killing it one day. I can have the best year ever this year, and next year I can completely suck or something. The insurance markets could completely collapse for whatever reason. Government injects themselves more into healthcare than they were before. And this business that was worth, however X millions of dollars now is worth nothing. Right. And so I've always been like hearing my dad talk and hearing my grandpa's stories, like pull it off the table when you got the chance. As long as you're still rolling dice, which essentially every deal we've done, we're always rolling dice with the new acquirer, was kind of our belief of like, let's pull off what we can, make sure that our house is safe and protected, and to steal, love him or hate him, to steal Dave Ramsey's, like nobody can take something if it's paid for, right? And like, I can sleep much better knowing that I don't have that risk. Mm-hmm. And it also makes you much more dangerous business-wise when you're not trying to cover a note every day, right? True. And I think that's what led us, although it was a little out of order, but it's coming back in order, is like, that's what led us into going down this, print shop business. So at the time we were in the midst of our second year of our earnout with the original private equity group. And the way we had our deal structured, essentially my partner, Jeff, was on a fixed income, right? He was like, hey, because I'm not in sales, I'm in operations. I don't have exponential growth upward. I have kind of what I know my range is. And he's like, I want to go buy another business. And I'm like, dude, whatever you want to do, I'm in, right? So we looked at everything from FedEx routes to like, steel companies, which the good thing we didn't go there, to a variety of things. And he comes to me one day, he's like, hey, there's this little print shop. It's doing like $2 million of sales. We can buy it, or, call it 50% of sales. What do you think? And I was like, I don't know. Do you think it's got like good margins? Like printing, like, isn't printing dead? This guy took a bunch of thought, like, who wants to buy a print shop? Because everybody's going to, everything's on your, your phone. And he's like, yeah, but he's like, just look at it. It's like consistent. And we started diving into it more, and we realized that these little print shops are essentially just like insurance brokerages. They're all mom and pop shops, right? There's not really at this point in time any big conglomerates. You have some of the franchise names, which we became part of, but like there's no, and I'll use the insurance world, there's no Aon or Marsh or Hub or Gallagher out there that owns print shops. It's just a bunch of either franchises or mom and pops that have these things. And there's a bunch of people that got into them, back in the 70s and 80s who are now 60, 70, sometimes 80 or 90 years old that have good businesses that they just haven't modernized. They haven't done some, like actual like future business planning. And it's a lifestyle business, just like insurance was a lifestyle business. And so like it resonated, even though I knew nothing about printing, Jeff knew nothing about printing, it resonated with us because it's where the insurance business was 25, 30 years ago. You traded an insurance brokerage in 2005, traded for 1 times revenue, right? So like 1 times revenue, you can't even get close to, now you're talking 5, 6 times revenue right now, right? If you're just talking revenue, not even EBITDA. And so he came, he showed me this deal and we looked at it. And I said, look, I got one deal with you, Jeff. I'm in, but I do not want to be there printing paper on a Saturday. Like to your point, Glenn, I got 4 kids. I got crazy stuff going on. Like I'm in, but that's the one thing I'm willing to help in whatever way, shape or form. But like, we got to have an operator. We got to have somebody who can operate this thing. And we were able to find somebody who could come in and take over the operations of that business. And then we took the first year and essentially said, let us learn everything we can learn. And let's make every mistake in the first year humanly possible. And I will tell you, we made all of them. Like every single one. We dumped more money into that thing in the first year than we planned on because we screwed up, right? Like we did stuff that anybody who buys a business and that's not accustomed to the business just doesn't know, right? Mm-hmm. And I'll give you the example of like, we laugh about it. And Jeff and I laugh about every financial loss we've ever had. We don't get pissed off about it. We don't get upset about it. We just kind of chuckle. And if I have time, I'll tell you about the real estate deal that most people would have like blown their brains out on, but we just kind of laughed at it and it made us probably more money than some of the other deals have, right? But we went into the deal assuming that the cash flow is just like insurance. Well, it's not, because you have clients that are going to be, 90 days out on paying, 120 days out on paying, 60. There's no range in understanding. And unlike an insurance contract, if you don't pay it, the insurance company cancels it, right? So what's the first bill after payroll most people pay? Insurance, because it'll get canceled otherwise. Mm-hmm. The last bill anybody's paying in a business is their print invoice, right? So that thing's like stack number 7 on a stack of 6, Mm-hmm. And so we learned the hard way that working capital is a very important thing in that business. But it was great because we didn't understand it. And so, we learned things through each one of those deals that as we go into these other ones, which we've got a couple that we're lining up right now, to look at, is like we started to understand some of the pitfalls that we made. Like working capital in a business like a print business or something where you've got a lot of receivables that you don't have contractual control over. It's important. Mm-hmm. Working capital, it blew us away on how important that was, because the reason we had to dump money in is because we just didn't plan for that. And so we have a thesis that the print business is essentially the insurance business, and that it's just a little bit different. But the idea is that people will go back to the same print shop that they went to for the last 20 years and order the same business cards and order the same print material and the collateral and all that sort of stuff. And we have some other thoughts on it too, but I'll stop there because I rambled a bit.
And are you buying these for 15x? Auto insurance?
So
What's
no, so the way right now the way that it's looking as we look at them is, and I'm not an accountant, so just take my dumbed down, cowboy math as I explain it. So if you've got a shop that's doing $100,000 of sales and gross profit is, call it 750, right? Or probably more like 600 would be the right number for it. You're buying it for somewhere around 300 to 400. So it's about 50% off the gross profit, right? And then you have your net profit down at the bottom. If I'm explaining your math in the accountant world,
the multiple on net profit, you're getting them for what, like 2, 3, 4 times?
yeah, maybe. Yeah. I mean, and a lot of these guys are running it out to zero anyways. So you can't even find what the net profit is because they're just literally, and a lot of them, when you think about a print shop, right? Most of them are owner operators that are inside that room printing these businesses themselves, like doing the stuff themselves. So our belief is if you have one like mothership that can do for a region. So I'm not talking for the whole, like wherever you send, but just talk geographical region. If you have one mothership that has all the printing capabilities to do large format, printing, mailings, signs, whatever you need to do, right? If you have all of it in one location, and then you go up and pick off these smaller ones that are out there, and you're buying them at a much lower multiple than we would in the insurance world, right? Like, call it 2, 3 times. We can then essentially stop having to use their location to print the stuff and send it back. And what you get rid of is the overhead of the salaries. The owner salaries are essentially what's driving the majority of the cost. You don't need the owner salaries because you already have all the printing and all the location and all the machines that you need back at your central hub. So essentially what you've done is created a storefront, right? Storefront for the majority of your walk-ins that I need a quick, 100 copies of this piece of paper. Fine, we can do that here. Anything big gets sent back to the main center. And essentially what you're getting rid of is the need of having everything on site at all these different places, and you're consolidating it into one physical location. The goal would be to have 24/7 of production going constantly because you can essentially credit.
So have you bought more than one already, or how many have you bought?
Yeah, so we've got one today. We tried to buy one within the first 6 months, but because and we're about 14 months in right now. So we've got one today. That one does about $2 to $2.5 million of sales a year. And that's our mothership. That's the reason we bought it, right? We said we needed to learn everything we could learn in that first year possible. We tried to buy another one, but because of our franchise relationship, they said you're held up for at least 9 months to a year before you could buy another one. And we're like, all right, we kind of get it. They don't want us just going out and buying them and then just cratering all these things. So we're currently about ready to submit an LOI on one right now. And then we have 3 more on the horizon that we're looking at. And one of which is pretty likely, because what you wind up hearing is Bob wants to retire, right? Or Sally wants to retire, or so-and-so's, husband or wife died. And not a lot of people want to get in the print business because it's not a sexy business. It's a dirty business. And so we were saying we could probably go on a run here in the next few years of picking up anywhere from 1 to 3 a year, depending on the size. And if we get the one we're trying to do right now, we can essentially cash flow all the purchases. So we don't think we'll have to take out much debt on them, because you're not talking about large dollar amounts, right? Average print shop's still between $500,000 and $1 million of sales. If you can get it operating appropriately off the gross profit, you should be doing like 25% profit margin, which is the insurance world. 25% profit margin is like what we chase all day long. 30s if you're doing great, 35s if you got it really dialed in the insurance world. The print business, and this is like franchise information, and it's like pretty standard. If you get it dialed in, you should be at like 25%. And so we look at it going like, man, just pick up a bunch of these guys over a time period. It's not fast, but it's just consistent business coming through. And this is where it's interesting having business from the insurance side, but then also having corporate relationships, but then also having the side business. I was having the lunch with the CEO of a hospital recently, and he was telling me, he's like, "You want a print shop, right?" And I was like, "Yeah." He's like, "Man, we brought everything in house. Tell me more." He's like, "We're wasting so much money on the people we have working in there, on repairing the machines, on printing all this stuff." And he's like, "Here's the thing. When we were doing it, we were spending like a couple $100,000 a year on printing." He's like, "Now we spend like maybe 80 to 100." He's like, "And that's if we shipped it all out." So what happened is you had everybody printing everything originally, and then everything went digitalized, right? Think of a hospital. You go in, it's all done on an iPad. Well, now it's shifted back where he's going, it's a waste of people and machine to have it inside. Let's just ship it all out. I told him, I go, "I'll buy your machine and we'll take your contract right now. Like, we'll sign a contract with you to do all your printing for you, and we'll buy the machine off you, because God knows we'll need the machine at some point in time." And he's like, "Yeah, that's a really good idea. We should actually think about it." And so I think there's going to be a renaissance back where all these companies that took it in-house are actually going to ship it back out because it's cheaper and less expensive than having to try to maintain and hire and manage that side of the business as well.
Yeah.
That's really interesting. Makes sense. And you're looking at some of the other franchises that are up for sale, or you're looking at independents and then converting?
All of them. So if we buy any, we have to convert them underneath our franchise model, right? And we always look big picture. Some people will be like, "Well, that's stupid because you're paying a franchise fee to be able to access it and all that." And it's like, yeah, but we also get like a lot of really good intel and leads from it, and you start to build like relationships within it.
Yeah.
You know, like if I'm out to make a quick buck, then yeah, you're right. Franchises probably don't make the most sense. But if we're looking at it from like a long-term perspective and the value you get from like the group thought, then we're like, it helps out two idiots that are in the insurance world trying to get into the print world, because we got people we can go bounce stuff off of.
Right. Makes sense.
But we'd buy either. We'd do the franchise ones that are existing, or we'd go buy just your standalone mom and pop.
Yeah. I mean, our first guest did that in Midas. You know, he started with one Midas franchise, and now he's like doing 35, 40 million.
I listened to that one. He was pretty interesting.
Yeah.
He was inspired, if I remember correctly.
Yeah. And I've seen it in other franchise verticals as well, as like you can move that much faster on acquisitions, and you get the inbound deal flow because the word gets out that you're acquisitive, and it's just that much easier to like rinse and repeat.
And, you know, and I'm no expert in this in any way, shape, or form, but having watched private equity people do what they do, you start to gather and understand like ways you can structure deals, right? And the deal's never a no. It's just maybe we aren't at the right terms right now that make everybody comfortable. And that's the one thing we were talking about today. It was just like, Jeff and I go to lunch when I'm here, we go almost every day. And we'll talk about either insurance stuff or print shop stuff. And the idea of it is just like, we kick around the idea, and it's like, there's never the answer is never no. It's just, how do we find this middle ground? Like, if somebody wants more money, that's great. We'll give you more, but we're going to pay it on our terms at that point in time, or on a retention basis. Like, and so I think there's an opportunity on all these things to try and make it, amicable for all, I guess would be best.
So take me in the head of you and Jeff on the print business.
Yeah.
So this is the first kind of like, I would say, just you guys didn't kind of get into it through the family business. Like you just decided, we're going to buy this. We're going to build this. We're going to do this hub and spoke system.
Yeah.
With mothership. What would it take to pry that out of your hands? Like, do you have a number? Like, is it like,
so this isn't our first rodeo in it.
Yeah. Is it a means to an end? Like what's our end goal here?
So I think a good way to put it is, so he and I did a deal a few years ago on my office building that I was referencing, right? And our long-term plan on that was to hold it and to use it as, just to pay expenses, all this other stuff. And then we had a private or family office come to us and make an unbelievable offer on the building, right? We had it fully rented out. It just made all the sense in the world. And we sold it at that point in time because it made enough financial sense for both of us. I think, given our stability, with what we've got from the insurance perspective, from an income and from a net worth aspect, that like we're not chasing the one-off wins to make ends meet anymore. And so, is this something that we could hold on for our kids to take over one day, or to, sell to one of our kids or something along those lines? Who knows? Maybe. But if our belief is right, then maybe the printing business is coming back and it is undervalued, and like the insurance business was, and people will start coming around and wanting to buy these things at silly multiples than what we bought them for. I don't think either of us are naive. Not naive is the wrong word to use. We're not motivated for, hate to use the word ego, right? But like holding on for like personal value, right? We'd much rather look at it and be like, all right, is this a good deal for you? Is it a good deal for me? Do we want to get rid of it? Do we not want to get rid of it? And that might happen, Clint, at $10 million of revenue. It might not happen until we hit $100 million in revenue if we hit it, right? Like, I don't know what it is. Things have just changed a little bit. And we're now playing, not with house money, but we're just not worried about we don't have to take anything out of it, right? So it's like, all right, can you grow it? Can you create like a really cool business out of this? And can we prove long-term wise that our belief was right? But I don't know. Somebody comes and offers us 6 times, 8 times, 10 times. Yeah, maybe the story changes.
So it sounds like almost you've got like a kind of a pragmatist, opportunistic mentality of like, hey, I know what I paid for these.
Yeah.
We're building them to be durable, cash cow businesses that we can hold forever. We don't need to sell, but I'm always open to it if I feel like on a macro level, like the stars have aligned here. This is getting hot. The timing feels good. So it's more like feeling the right timing for you. Is that part of how you think about it?
I am an opportunistic person. That is the best way to describe it. And I think Jeff is as well on that side of it. And it will be at some point in time, we'll just be sitting there, we'll get a hair and just like be like, screw it, we're out. Like let's sell it. And we'll just decide to do it. And will it be the best decision we make? Who knows, right? I jokingly say that like people will say to me, do you think your first private equity deal back in 21 was the best deal you ever made? No, we could have made way more money if we sold it to somebody else, right? And back in 21, we've done really, really well. But we wouldn't have collected all the dots along the way that painted the picture we're at today, right? And I think that's the thing, like we look at is like, what's the bigger picture on this? I'm like, what does it all kind of turn out to be? And we'll find a way to make it work. Like something that seems like it's bad today will turn out to be good in 5 months or 5 years. We just don't realize it yet. We don't know what the dot's supposed to turn into.
Yeah. I'd like to compare business to real estate for a second, just metaphorically, right? So we all own houses, and everybody always says like in the normal world, like your house is your biggest investment or whatever. But I'm like, nobody treats it like that. Like we don't sell our house opportunistically. Usually we sell and buy houses completely emotionally. I put a contract in to buy a house, just dumb luck in 2020 before prices like exploded in this neighborhood. And my house I was getting it built. And by the time it was built, it was probably worth like 30% more than what I paid for it. And it's probably doubled in just a few years since I bought it. But I know that's not sustainable. Yeah. And like if I treated it like an investment, I know the right thing would have been to sell it like maybe last year, or something like that. Because I'm like, these houses are selling for stupid prices, more than double what I bought for it. If I was smart, I'd just say, all right, I got lucky. Let's cash our chips out and let's rent and then wait for the market to cool back off. And but we don't think like that, right? When you own businesses, it's this neat thing where like, if you can detach yourself emotionally, because unlike our houses, we don't have to live in our businesses, right? You don't have to own 2 businesses all the time, or 1 or 0. Like you can own as many or as little or 0 as you want. And so there is this sense is if you can get out of the mentality of I'm emotionally decided I'm going to hold this for X amount of years, or I emotionally decided this is what I'm going to do till I retire, but keep an open mind, an open heart, and look for, wow, do I feel like this thing just went up through factors of luck and timing and things that, because part of being lucky is just like owning stuff and taking good care of it and knowing when to sell and when to hold. And like, it sounds like you're kind of like riding those vibes or like kind of trying to be in tune to that and are willing to capitalize on that, where others might be more dogmatic.
My business is not my life.
Yeah.
Right. And I think that's the thing. And I've seen a lot of people whose businesses and whose life is work. And it's like, no, my life's sitting 10 miles from here at my house with my kids around, drive me nuts 90% of the time, but I'd take it anytime, like any day. And like, that's the stuff to me that I think I'm probably in that idea that you laid out so eloquently, is like, no, to me, a business is an end, like a means to the end, right? But it's not who I am and not what I'm going to be. And I said it a long time ago. I could be selling porta potties and the of that business, and I'd be happy. I could be selling accounting and I'd be happy. I don't care what it is. It's just
Accounting, that's a little too far.
Well, I know. I mean, I think it'd be a really good salesman of accounting. I couldn't do the auditing, the accounting. That'd be way too tough. But yeah, I think it's really well put, because work's not my identity, I guess is the best way to put it.
That's great.
Great perspective to have, man. This has been a fun conversation. I feel like we could go for a while, but we might need to put a bow on it. So you had the exit with the insurance business. Congratulations. I feel like we need to follow up episode in a couple of years to see, where
the insurance business is, right? Let's see what goes there. And then let's see what the print business is, right? I mean, all those would be.
Yeah, I'd love to see if your print thesis proves out, because
I have a thesis on the insurance one. You just probably don't want to hear it, but yeah.
Well, this is fun, man. So, if people want to connect with you online, where's the best place to do that? Is that LinkedIn or?
LinkedIn's probably the best way. Yeah.
We'll put a link to that in the show notes. And Matt, this has been awesome. Congrats on the exit, and congrats on the print shop venture here as well. So
thank
you for coming on, and we'll be in touch here soon.
Thanks for having me.